Good evening, everybody. Please take a seat. We'll start right away. First of all, dear Professor Gerard Harford, dear Professor John Dukas, dear members of the European Financial Management Association, dear colleagues, the Rector brings you his warmest welcome. He expresses his gratitude to EFMA. Unfortunately, for a very last-minute inconvenience, he cannot be here with us tonight. So I will say a few words to introduce our great keynote speaker. But before that, on behalf of the Università Cattolica del Sacro Cuore, I would like to extend my warmest welcome to you. We are very pleased and honored to have hosted this great meeting, the 2008 annual meeting of the EFMA Association, and to have cooperated with EFMA, an association becoming more and more a reference point in the international financial community. I sincerely thank Professor John Dukas and the Board of Directors of EFMA for giving us the opportunity to host this great event. With reference to the topic of the keynote address, I would like just to mention the importance of mergers in today's world, not just for the financial community, but for every one of us. Indeed, if you think about what we have read in daily newspapers over the last few weeks, in the US there was a landmark court ruling on the AT&T acquisition of Time Warner, a decision awaited by the entire media sector and beyond, with implications for several media deals that are reshaping the industry both in the US and in Europe. And we all know that mergers are also an issue that is hotly debated here in Italy, especially concerning the banking industry. We had a session yesterday where they discussed briefly also this important topic. And the governor of Bank of Italy, Ignazio Visco, recently stated that mergers are essential, jointly with cost cuts, to increase Italian banks' profits and allow them to comply with capital requirements imposed by the regulators. Merger acquisitions are just one of the topics that we have discussed in depth during these 3 days of the EFMA conference, in the many sessions that we had during this conference and that we will have also tomorrow. To conclude this intense and stimulating day, I have the pleasure to give the floor to the keynote speaker, Professor Gerard Harford, the Paul Pigott Packard Professor of Finance and Chair of the Finance and Business Economic Departments at the University of Washington's Foster School of Business. We are all familiar with Professor Harford's many accomplishments. He earned his PhD in finance at the University of Rochester, and he currently serves as managing editor of the Journal of Financial and Quantitative Analysis, one of the top journals in our profession. He's also an associate editor of the Journal of Financial Economics and the Journal of Corporate Finance. We all know that his primary research areas are merger and acquisition, corporate governance, and payout policy. He has published several papers in top finance journals. It's very difficult to count them all. His teaching focuses on core finance and acquisition analysis, and he has co-authored one of the leading undergraduate finance textbooks. We are all looking forward to Professor Harford's keynote address, and I would like to thank him on behalf of this university for his great contribution to the conference and, of course, to the finance community. Once again, congratulations to all of you for the great work done during these days, and I'm looking forward to Professor Harford's keynote speech. Thank you.
thank you very much for that very nice introduction, and let me just take the opportunity to thank you for your hospitality and for all the work that you and Elena have done to organize such a wonderful conference. I know it's an amazing amount of work, and I think it paid off nicely. Thanks very much for coming to listen to what I have to say. I know it's been a very long day with sessions starting early in the morning, and after me, we've still got awards and a gala dinner, which will be way more exciting. So let me just get into what I wanted to talk about, which is rather than dragging you through the details of one particular paper for 45 minutes to an hour, I figured I would just talk about what, at least for me, are the broad takeaways from almost 4 decades of mergers and acquisition research, drawing, hopefully understandably, heavily on my own work, and trying to make an argument not only that mergers matter, but they matter because they have much broader effects than we typically think about when we focus on the parties to the mergers themselves, which tends to be the focus of a lot of research, and start thinking more broadly about the impacts they have beyond just the firms that are merging. So I just want to start out with a few motivating facts and about sort of why merger activity is particularly important and kind of putting today's activity in context. So, one of the themes of my research, and certainly a well-known fact about mergers, is that they cluster in time, and this is typically referred to as so-called merger waves. And here, just by sort of US dollar value, we have activity. And so by US dollar value, the 80s merger wave doesn't look that impressive, but once you sort of scale by the fraction of the market involved, which I'll show you in a slide or two, it still looks pretty impressive. Of course, we had the 90s merger wave, which was more of sort of a global one, and then we had the aughts, and then that was cut off by the global financial crisis, and we've had sort of a nice recovery since then that's actually already effectively peaked, even though we're seeing quite a bit of robust activity, although with this sort of trade spat turning into war, we're seeing sort of a reduction, at least in cross-border activity right now in terms of 2018. So it sort of remains to be seen whether we'll hit another trough or continue. But it's a lot of money. Often, globally, it can often be multiple trillions of US dollars in activity. And it's not a new phenomenon either, right, that mergers cluster and have in fact aggregate merger waves. If you look going back at least as far as CRISP goes, and you start asking, what fraction of publicly traded firms are acquired, so that's the blue line. So the blue line is basically capturing merger activity by number. The red line is fraction of market cap, so the red line is effectively value weighted. You see that this has been going on for a while. So there was actually a merger wave leading up to the Great Depression that was related to, at least in the US, the sort of radio technology, railroads. We sort of had national brands were building out as sort of more disparate communities became integrated, something we're seeing on a more global scale. Now, the Warriors saw a significant reduction in activity, but then we had, with the so-called conglomerate merger wave of the 60s with sort of companies joining together that had very little to do with each other, which was then undone in the 80s merger wave, often called the bust-up merger wave, that was fueled by junk bonds to pay for the raiders who came in and bought the companies and split them up and sold them for the sum of the parts was more than what the original company had been trading for because of the conglomerate discount. And then you see the more recent waves I showed you as well. In some of my own work in 2005, I sort of asked the question, what drives merger waves? And this figure is sort of a key figure in that paper, and it takes a little bit of explaining, obviously, because it's kind of busy. But basically, I was drawing heavily on some work that had influenced me by Mitchell and Mulheron, which was in the 1996 JFE, where they talked about how if you really want to understand merger activity, you have to realize that a lot of it is happening in the context of industry level merger waves. So there's a shock to the industry's operating environment. It might be regulatory deregulation, it might be technological, it might be economic, like increased import penetration, but something shocks the industry's operating environment, and then the efficient way to respond to reallocate assets is through increased merger activity that looks like basically an industry level merger wave. Now, that's all well and good, and it moves us forward considerably in terms of understanding not only the clustering of merger activity, but obviously if you want to understand the drivers of merger activity in general, you have to understand the context of them happening in a merger wave. But the problem is that it still didn't explain why these industry level merger waves co-located in time to create an aggregate merger wave. And so the key is that you have to have some kind of macro level factor that effectively greases the wheels. And there was a paper by Eisfeld and Rampini that made this point that capital liquidity, the liquidity of reallocating capital in the economy is highly cyclical. And so if you look at, the question is sort of how do you capture this sort of receptiveness to financing these kinds of merger activity? Well, the Federal Reserve asks senior lending officers, are you planning to tighten or loosen credit over the coming quarter? That turns out that the answer to that question in the aggregate turns out to be incredibly useful in predicting not only lending standards, but then real activity, because tightening lending standards have a significant impact on real activity. The problem, of course, was that even though they were doing something particularly useful, they stopped doing it. So they stopped asking this question, but it turns out the answer to this question is highly correlated with what's called the C&I rate spread, how much above federal funds rate are you charging for commercial and industrial loans? And that's the blue line. And so basically the blue line captures as the blue line goes up, basically financing is tightening. And it turns out this helps explain whether or not a shock to an industry propagates a wave, because you have to have this sort of macro ease of capital liquidity to actually propagate the activity. And so these gray bars are basically a particular industry in a 24-month wave and one industry per line. So this might be banking in the 80s and banking in the 90s. But you see that basically these aggregate waves were made up of a co-location of a lot of industry level merger waves that were happening at a time of decreasing cost of capital reallocation, and were often cut off by a further increase. And at one point I actually extended this. That paper only looked at the 80s and 90s. I extended it through 2010, and you can sort of see what was happening in the global financial crisis was this C&I rate spread was spiking. So before I get into some of this broader stuff, I wanted to sort of set the stage with some of the prior findings in the literature, for example, on value creation. So this graph I'm actually borrowing from a very nice and comprehensive survey paper written by Betten, Ekbo, and Thorburn, and Karen spoke earlier today in the PE session. But I really love this graph because it says a lot. So this is basically, so day 0 is the announcement date, right? And so you've got the target run up, right? So so this is the target stock price leading up to the public announcement, right? So this part here, this is basically illegal insider trading. It's always fun, right? And then you have the spike at the announcement, and then you have the bidder as well. And so obviously the target stock price spikes because you're being offered 120 for something that used to be worth 100, but the bidder stock price, it's interesting. Basically, when the bidder is buying a private target, it has a positive and lasting increase, and when it's buying a public target, it has a slightly negative and lasting increase. And we for a long time, we thought most of the research was on public acquire, public targets, so these public acquisitions, and so you had this sort of general takeaway, that mergers are either a push or negative for bidders. It turns out that's in the case of a public target. If you actually look at sort of what kind of deals the market likes for bidders, it's, well, you know, there's a couple of common sense things. If they face less competition to acquire the target, they're not being bid up. You know, Moeller, Schlingmann, and Stoltz showed that if the bidder is, that one very robust empirical finding is that if the bidder is a smaller firm, it does better acquisitions. And they, through some analysis, they kind of concluded that it was most likely this was due to reduced agency costs in smaller firms. If they pay cash, then they're not sending a negative signal about the value of their equity. But combined with this next one, if they acquire a privately held firm, there's some results in the literature that show, actually quite interestingly, that this result that you have a bigger negative reaction when you use equity is specific to the public case. When you use equity to buy a private firm, you actually have a positive reaction, and a much more positive reaction than when you use cash to buy a private firm. Now, why would that be? Well, the current best story that is consistent with the data is that when you buy a private firm with equity, you're essentially creating a block holder, because the private firm has concentrated ownership, and you're placing a huge chunk of your equity with somebody who is now very incentivized to monitor you, because a big chunk of their wealth is now tied up in your stock, and the market likes creating incentivized monitoring block holders. Now, there's been a lot of debate about what happens after the deal. I would say that the bulk of the evidence does support operating improvements, so it's consistent with the existence of real synergies. There's some studies that would put this to be more concentrated in cash acquirers. There's also some evidence of poor long-term stock price performance, but this is really concentrated in these large public acquirer, public target stock swaps. But because it's very hard to get long-run stock return studies correct, because of if you mess up the market model, it just compounds, there's a lot of debate about what to make of those results. But all in all, I think that the bulk of the evidence is that there are actually synergies and the mergers are a good thing. The funny part is that even though well over 80% of mergers show signs of value creation, that if you actually just add up total value creation and value destruction over a 30-year period, you end up with something close to zero or negative. So what's going on? Well, the vast majority of mergers are value creating, but the ones that are value destroying are the really, really big ones. So on a value weighted basis, it ends up being more of a push or negative. And I'll return to that in a minute. If you look at the results in Loughran and Vish, who did one of the first long-run stock performance studies following acquisitions, and then I created this graph based off of one of their tables. The groups down here are relative size. So high target size to bidder size means kind of a merger of equal type scenario. So this is large public target, large bidder, large public target relative to bidder. That's where the actual negative returns are concentrated. When these stock swaps, these really big merger of equal stock swaps, that's what's giving mergers sort of a bad rap, is these sort of bigger, high-profile mergers. Cash shows really very little sign of being a problem in the long run, and stock really only in these sort of high quartile size deals. So I think that on average, at least by numbers, for sure, mergers create value for the combined shareholders, and this shows up in announcement returns, post-merger operating performance, long-run returns, except for that one subset. And other studies that I haven't talked about have largely ruled out wealth transfers. So this isn't coming at the detriment of customers or other stakeholders like labor or bondholders. It really is wealth creation. However, these large public stock swap mergers do appear on average to destroy value, and because they're so large, the value destruction is huge, and that's sort of the offsetting of all of the, by number, other ones. So you might say, okay, well, why keep doing these big acquisitions if the evidence is against a good outcome? Well, you might look at the incentives for CEOs to actually do acquisitions. So Grinstein and Hribar look directly at bonuses paid to CEOs in merger years. And these are identified in the proxy statement as a bonus paid for all the extra work the CEO did in doing the deal, completing the deal, and integrating the target. And so you look, you say, well, gee, if you look at the non-M&A firm years versus the M&A firm years, you get paid sometimes $4 million on average as an extra bonus for doing this merger. So you might say, well, okay, you get this bonus, but with this explosion in the 90s and into today of equity-based compensation, we should have basically fixed this problem. That was the whole point of all of this equity-based compensation, was to make the CEO more like a stockholder, so if he or she does a really bad acquisition, then he or she is going to suffer along with the shareholders. So Kai Lee and I took a look at this exact question in a 2007 JF paper where we looked at the existing portfolio of stock and options of the CEO and said, okay, what happens to their wealth from before to after? And what we found was that, so first of all, there's definitely an incentive to do a better acquisition than a worse acquisition, right? You're definitely, so by outperforming and underperforming, this is just, did the acquisition create value or destroy value for bidder shareholders? And then look at what happens to the bidder CEO, right? So the green bar, you're definitely better off. You definitely get, your wealth increases a lot more if you do a good acquisition. But in terms of if you do a bad acquisition, it's actually pretty rare for you to lose, for your wealth to go down. You have to be a little bit below the 25th percentile of CEOs in that group to actually lose money along with your shareholders. And so you effectively have an option-like outcome, right? You know, either the acquisition will turn out well and you'll have a huge increase in wealth, or it'll turn out badly and you'll pretty much be okay. So what's going on? It turns out that if in the acquisition year, the board grants the CEO a huge slug of new options and stock that more than makes them whole for any losses on their existing portfolio. And we have evidence in the paper that this is more concentrated in weaker boards, so it does appear to be a governance issue. So basically, there's a lot of incentives to just do an acquisition. In another paper that I don't have a slide about, we show that just having done an acquisition, even value-destroying acquisitions, results in way more board seats once you retire, because you have acquisition experience, even if it was experience in doing it badly. So there's lots of incentives to do acquisitions. Okay, so some of the stuff that I've been really interested in recently, and part of this is a plug for getting more involved in these data and doing some of this stuff, is the network effects. So, you know, in the Mitchell-Maharon paper and then my follow-up paper in 2005, you know, it was moving to the industry level for context and then bringing in the macro context. But still, the unit of observation was essentially the industry. And so not really recognizing any context of what was going on in other industries. So papers sort of treated the industries as if they existed in isolation rather than as part of an economic network, you know, that's connected through like supply chain type flows. And so in this, you know, it's clear that industries are linked to other industries through economic flows. And you could think of this just the way you can any kind of network, social network or economic network in this case. And in particular, it should matter whether the industry is in the middle of this network, you know, is sort of central to this network of economic activity, or whether it's on the periphery of this network of economic activity. And if you sort of go and really work through the data and actually map out all these connections, eventually you can have a network representation of the economy that I would argue is quite useful for all kinds of studies, not just the merger study that I did. So in work with Kenneth Ahern, in a paper we published in 2014, we just took this simple observation, right, that industries don't exist in isolation, and so this could be very useful in understanding which industries are going to have cross-industry mergers, how does industry activity propagate through the economy, right? And so obviously there's direct propagation, like vertical mergers through the supply chain, like when we had content providers buying content distributors, and we're seeing sort of another mini boomlet in that area as AT&T is now completing a merger of the outcome of this particular merger, right? But you can also have indirect effects through the network where a merger wave in an industry that's economically linked to you itself is the shock to your industry operating environment that forces a reaction from you. And some of this goes way back. Galbraith had a paper in the 50s about countervailing market power, right? My supplier industry undergoes a consolidating merger wave. Now my industry has to undergo a consolidating merger wave just to maintain bargaining power in the supply chain, because we have to get big because all our suppliers are now big. But you can also have just changes in substitutability in your input function, changes in costs, or so forth can all indirectly lead to this. And so you can have mergers in industries that are vertically related, but not just pure vertical integration. So our argument was simply that that mergers will travel through these product market links, but you have to map these product market links to actually be able to empirically see that. And so we basically asked two questions. Do industry links predict cross-industry merger waves? So does knowing the economic map of the economy at an industry level help you understand how mergers are going to happen? And more dynamically, can you see the merger activity propagating through this economic network and understand better how aggregate merger waves actually happen? And so just to give you kind of a small example of what we did, the data are actually 471 by 471, because that's the way the Bureau of Economic Analysis very conveniently produces every 5 years this input-output matrix. How much does every industry buy from every other industry? And so you can actually see these economic flows and build out this economic network. And at least in the data we were using, there were they had created 471 of these industries. So this is a small part of the overall economic network. It's sort of the part that's involved in producing wood doors. But it kind of just shows you sort of the richness of the data, that these are the various industries involved in this. It also shows you that there's some nice, useful asymmetry in the data, right? So for example, logging supplies almost a quarter of the input that pulp mills uses. But logging is so big that relative to pulp mills, that the pulp mills is only buying 2% of logging's output, right? So the point is that using these data, you can actually go further and say, okay, logging is an incredibly important source of input to pulp mills, but pulp mills isn't really that important to logging because of the difference in the size there. So the data are very useful. You can build them out. You can use all the graph theory and all the tools that have been built up and used in analyzing social networks and so forth, but you can do it in the context of what I would argue is a more important network, an economic network. And so why do I show you the timber part of the network? Because there's a nice example there. So from I live in Seattle in the northwest of the U.S. There's a lot of logging, a lot of forest in the northwest of the U.S. But in 1990, the northern spotted owl, which only lives in Oregon and Washington, was listed as threatened, which is one below endangered. So there was this injunction and this plan, and 24 million acres was taken offline. You couldn't log it anymore. So this was a a huge deal in the timber industry. And so basically you could see that the amount of harvest went way down, right? And you could actually, this is actually the price of a log, not log price. But anyway, so the price of a log went way up, and so you had this huge shock, right? So what happened? Well, first sawmills underwent a merger wave, then forest nurseries, then it spread to pulp mills and logging. If you sort of recenter everything, you see that the duration and intensity of the merger waves was very similar as it moved through this part of the economic network. So in that paper, we were more broadly using, actual formal econometrics to show how these shocks diffuse through the network and help create aggregate merger waves. And we were also able to show some sort of interesting timing effects, right? So that a shock that, merger activity in a distant industry is eventually going to matter to your industry, but with a lag. Whereas if there's a lot of merger activity in industries that are closely connected to you, then basically it's highly predictive that next year you're going to enter a high merger state, right? And this helps us understand how aggregate merger waves form instead of these disparate shocks to different industries in the network kind of petering out, right? It ends up being ends up being very analogous to what you see in epidemiology in terms of the spread of a disease, because you could think of it as the spread of the merger bug, right? Is that, typically you have somebody enters Port City and is sick, and it's kind of people get sick in Port City for a while. Eventually somebody travels to Capital City, everybody gets sick, right? It's actually very similar with merger activity. There's some there's a spike in merger activity somewhere in the economic network. It starts affecting other industries. Eventually, it affects central industries that are highly connected in the economic network, and then merger activity blows up, and you get this aggregate merger wave. So, from that paper, we sort of concluded, okay, it's very useful to model the economy as a network of industries. It really substantially increases your ability to understand who's going to merge with whom, how merger activity moves dynamically through the economy. In a follow-up paper with Rob Schoenlaw and Jared Stanfield, who were students of mine at the time and now gone off and are professors in their own right, we have this paper that's coming out in Management Science where we looked at the industry level links. This is a little bit harder econometrically because you don't know exactly how every firm is linked to every other firm. They're only required in the US by law to list a customer that represents at least 10% of their revenues. So that's the way you can identify these links. So you have an incomplete view of the network, but still some very important economic links. And so we asked some basic questions about, if you know these economic ties, does that help you understand who's going to be involved in a merger, which mergers are going to be more impactful in an industry, and so forth. And what we found was, these economic links are obviously critical determinants of value. The problem is mergers reshuffle those links. So, for example, you could have a lot of relationship-specific investment into a particular link with another firm. If somebody else comes in and buys you, that sort of threatens this particular relationship that has been built up. And so you could sort of identify particular relationships that tend not to attract merger activity, but also deals that involved a lot of economic links had a big impact, not only in terms of value reaction of other firms, but in terms of follow-on activity. So it was more likely that other firms in the industry were going to react by their own mergers or by increasing capital expenditures or R&D or so forth. So, our conclusion there was, again, that sort of broadening the context of the parties to the merger to understand how they're linked to other firms in the economy sort of helps a lot in terms of understanding the mergers and understanding how it generates follow-on activity. And I just wanted to put in a plug here for another way of understanding how firms are related to each other. that I think is pretty useful to an econometrician, which is this work that Jerry Hoberg and Gordon Phillips have done through their text analysis. And so one example they had in their 2010 RFS paper was that General Dynamics and Antheon merged, and by SIC 372 and 737, you might not have expected them to merge, but when you actually look at their product descriptions, they actually are highly related to each other, and they share several related firms, and so you have a better understanding of why these firms would merge and how it would impact other firms. So I've moved on to more recently working on cross-border activity, because that's becoming more and more important. And in some work that I've started with Eric DeBoat and Farouk Ahmad, we've been looking at how much better you can understand cross-border merger activity by understanding the trade flows. The idea being that the more closely linked two economies are through trade flows, the more you're going to see merger activity in one economy affecting merger activity in another economy, and potentially more cross-border merger activity, although that is a bit of an empirical question, because cross-border mergers can be either a substitute or a complement for trade. So I'm going to show a few pictures instead of dragging you through tables. This is, and Eric is a whiz with visualizing networks, but this is the import network in 1989. It's highly dense. There's very few countries that have literally no import or export to other countries. And then this is the merger network. So the thickness of the line tells you how much cross-border activity there was between two countries, and the sort of size is proportional to the amount of activity involving that one particular country. The trade network is too dense to really see what's going on, so I'm going to zoom in on the top 15 players in the trade network. And so you see, remember, this is 1989. So US, Canada, Japan, here's Italy, right? And sort of the larger economies in the world, right? And then the merger network is much less dense and has a lot of the usual suspects involved. As you move through time, just going to 2002, right? Again, the trade network's still highly dense, but if you bring in, you again focus in on the top 15, it's actually interesting. You can already see by 2002 the effect of NAFTA, because now US and Mexico is big too, along with US and Canada, and US and Japan has sort of decreased a little bit. China has now popped onto the scene in 2002. The cross-border merger network is actually becoming denser, right? As economies integrate, we're seeing more cross-border merger activities. This is a much denser. And the other thing to notice is that the sort of difference in scale between the largest nodes, largest countries and the next largest nodes is less, right? So you're getting more evening out of activity. And when you finally move ahead to 2016, in the trade network, now China is huge, right? By the way, this is not a political statement on my part. I realize Hong Kong is technically part of China, but this is the way the data are collected by the UN Comtrade data set. So you've got China, Hong Kong, US. I presented this paper occasionally in China, and it's become a big issue when you show China and Hong Kong as separate. But then you move on and you see, okay, there's also the merger network is becoming even denser as well. And so the question we asked in that paper is, okay, can you use this information, right, that is sort of visualized here? That if you want to better understand the intensity of merger activity in a particular country, the subject country, how much does it help to know how intense the merger activity is in countries that are highly connected to it through trade flows? And the basic answer is it helps a lot, right? So we basically built out these import-export based networks, and as well as domestic and cross-border mergers over the same period. And so there's a significant complement effect rather than a substitute effect. And the intensity of M&A activity in countries that are highly connected to you strongly explains cross-border activity, removing, obviously, activity directly to them, so we're not sort of explaining something with itself, but also, which was what I found more interesting, was it also explains your own activity. So like merger activity just between two U.S. firms, the amount of domestic activity is partly explained and in a growing way by what's going on in its trading partners, right? So, for example, German car parts suppliers start consolidating. That affects U.S. domestic car makers, right? And this also holds at the country industry level, which is interesting in its own right, but also helps rule out a lot of potential alternative explanations. Obviously, it's very hard to disentangle causality in this kind of study, so we have sort of pseudo shocks to the trade environment, tariff cuts, adopting the euro, accessions to the EU, the EEA, and the WTO, and we show that following these basically reductions in trade barriers, the effect of trade in our analysis on M&A activity amplifies. So it gives us some confidence in the channel that we've identified. The last thing I want to talk about in terms of the sort of broader impact of mergers is some very preliminary work that I'm doing now on ownership. So we generally think of mergers as these asset-motivated transactions, right? We're combining assets, we're reshuffling assets, but they actually turn out to have a big reshuffling effect of the ownership structure of the surviving firm, and in a surprisingly long-lasting way. So just to give you a sense of the scale, right, there's a lot of cash and equity is dispersed through M&A activity, okay? And obviously there was a huge spike in equity activity in the tech boom of the 90s, but even putting that aside, it still is a lot of money. From the standpoint of an institutional investor, in any given year, a significant part of their portfolio could be cashed out, so they're holding target shares, and those shares have now been bought and converted to cash or swapped into shares of the acquirer, right? Which in many cases they had, through revealed preference, chosen not to hold in the first place. So to give you just a couple examples that makes it easier to see what I'm talking about. So take storage technology buying network systems in a stock swap. Storage technology is 60% owned by institutions, a third of which also hold the target network systems. So they had a fair amount of overlapping ownership. After the merger, the institutional ownership of the surviving firm is actually 16 percentage points lower. Only half of Storage Tech's original holders remained. Concentrated holdings, which we often look to for sort of corporate governance monitoring type stuff, has decreased by 10 percentage points, as have blocks. And they've inherited a bunch of owners from Storage Tech. Okay, so a fifth of the combined firm owners are new, and half of those are coming over from network systems, the target. In one that's a little bit closer to a merger of equals, so Rainbow Technologies was not as large as SafeNet, but relatively large. Another stock swap, institutional ownership of the new firm is lower by 8 percentage points. Almost half of the bidders' shareholders have turned over. But because Rainbow Technologies was a relatively large firm and it was a stock swap, SafeNet, the acquirer, essentially inherited Rainbow Tech's block holders, half of whom still qualify as block holders in the new larger firm. And again, even a year after the deal closes, a substantial portion of the ownership structure of SafeNet is coming as basically inherited along with the assets from Rainbow Technologies. And so sort of more broadly speaking, how much is this happening? Okay, so the inner circle here are the smallest quartile deals all the way out to the largest quartile deals. And the larger are the deals, the more turnover you have in the largest holder. So your largest holder before you did the deal is not your largest holder when you're done. About half of the monitors, what we would have looked to as monitoring shareholders, are no longer there. If you look at all institutions, it doesn't look quite as startling. You have maybe about a quarter of the institutions turn over as a result of the deal. But when you look at institutions that hold at least 1% of the shares, it looks a little bit more concerning in that about a third to 43% of those larger institutional shareholders are turning over. As I said, even though the deal is done for assets, you're essentially picking up an ownership structure as well. So basically, this is just the percent of deals where the target 1% or more shareholders stay as 1% or more shareholders, about almost 45%. The target's top holder becomes the top holder in the new firm. So you basically are inheriting a top holder. Happens in more than a fifth of the deals. Target monitor shareholders become monitoring shareholders in the block in the bidder. Happens more than a third of the time, and target block holders become block holders in the new firm. Happens about a quarter of the time. And when you look at longevity, this is basically the percent of the institutional shares held by institutions that weren't there prior to the deal and arrived as part of the deal. It's actually there's a substantial amount of inertia. So even 3 years after closing, it's still a substantial portion of the fraction of the shares are held by basically new shareholders. So, basically I said this is highly preliminary, but the basic point is that mergers are asset transactions, but they also have major implications for the ownership structure of the resulting firm. And we also, given that we know that mergers cluster in time, especially by industry, when there's a lot of activity going on in a short period of time, when the dust settles at the end of this industry-level merger wave, the ownership structure of the assets in that industry can be very different, and it appears to have a relatively long-lasting effect. So, conclusions on the broad reach of mergers. So, we know they tend to occur in massive aggregate waves. They reshuffle assets considerably and reshuffle the links between firms. I argue that it's important to think more broadly rather than just focusing on the value impact or the operating performance of the parties of the merger to how they're impacting other firms in other industries that are connected. Right, and you can see this when you actually build out these economic networks and see how the impact of mergers is being transmitted along these links, and this helps you actually understand how these isolated shocks build to an aggregate merger wave, and you can sort of dynamically see which industry is likely to be the next domino to fall, and this actually works cross-border as well, where the economic links are trade links rather than maybe supply chain links. As I said in the part that I'm just working on now, it's not only the assets that are reshuffled, but the ownership is reshuffled as well, and you end up with a lot of difference in sort of what you think of as the external governance of the firm, and this appears to be relatively long-lasting. So, why do mergers matter? Well, we know they total trillions of US dollars each year, but if you start looking at how much impact they have as they reverberate through the economic network, you start to see that it goes well beyond the total dollar value of the transaction, and it affects the way firms and industries are connected and the way they're owned as well. And so with that, I'll switch to questions. I'm told that I can maybe, anyway. Okay, so again, thank you very much for your time and attention at what I know was the end of a very long day. So I'll go through these questions here. So one that was submitted through Pigeonhole: do advisors, investment banks play a role fostering M&A ways? Yeah, so it's funny, when I was actually early in the work on the What Drives Merger Waves paper, the 2005 paper, I was going to present it at a symposium in Hong Kong, and I saw, through some bizarre circumstance, I forget, I ended up at lunch with some investment bankers, and they said, well, what are you presenting? I said, it's this paper called What Drives Merger Waves, and they laughed and they said, we drive merger waves. Yeah, investment bankers drive merger waves. So obviously, I think that if you look at all of the research, not just mine, the takeaway, I would say broadly, is that mergers are clearly driven by an efficient response to some kind of shock that needs to result in the reallocation of assets. But there are certain conditions that help these along. So people who've looked at cross-border mergers in general have shown that, differences in stock market valuation help. Differences in foreign exchange help. They don't drive the activity, but they certainly help. So M&A advisors pushing particular strategies or particular targets are certainly going to help. They're going to, but I'm not going to say they drive it. So that was a long answer to what would be, do they play a role? Yes, I think they do play a role. Could there be a way to predict diversifying mergers? Well, it's a lot easier to predict related mergers. There's a way to predict diversifying mergers. I mean, I guess it wouldn't be through a lot of the stuff I did, But so first of all, let me step back. It turns out that it's actually kind of hard to objectively identify what's a vertical merger and what's a diversifying merger. There's this paper by Goyle that makes a lot of progress there, but actually mapping the economic network does help a lot with that, because you can say, okay, these two industries are actually connected in a way versus these are not. So it does help actually identify what would be a diversifying merger. Now, predicting it, it might be an agency type. There's sort of two reasons for a diversifying merger, right? One is an agency wants to sort of predict it based off of Jensen's story about sort of declining opportunities, increasing cash. The other is the sort of Llewellyn 1971 explanation for diversifying mergers, which is you reduce cash flow volatility by having diversified divisions, and that increases your debt capacity. So, I've seen papers that look at this idea of sort of reducing exposure to input prices. It's not really a diversifying merger, but I think mergers that have some kind of risk management characteristic, which you might say is diversifying, you might. But I don't have a good way of predicting diversifying mergers. And I should say that if I could predict mergers, I would just create a hedge fund and I wouldn't tell you what I was doing anyway. So, other questions? Of course, we could also just raise your hand. Do it the old-fashioned way, too. If not, then I will let us get to the fun awards part. But yeah, thank you again for your attention.
Dear Professor Harford, dear Professor Dukas, dear colleagues and friends of the EFMA, let me first congratulate with Professor Harford for the great speech. Really, thank you very much for the insightful and timely speech. It has been a great pleasure for our School of Banking, Finance and Insurance to host the 27th annual meeting of the EFMA. So welcome to Università Cattolica in Milano, and we really hope you enjoyed your time with us. Being the Dean of the School of Banking, Finance and Insurance, let me first say that the EFMA meeting has been a very relevant opportunity for the school, for its academics, and more in general for the European financial community. This is actually in line with the mission of the school that was actually founded more than 25 years ago in 1991, that is to contribute to the debate of the financial community to enhance the study of banking and financial management, emphasizing the interplay among the academia, the industry, and the regulators. And I think we had several opportunities over the last 3 days to enhance this mission. For the 2018 EFMA annual meeting, following our call for papers, we received more than 650 manuscripts of high quality. As a result, the refereeing process was very competitive, and we had 142 colleagues from top academic institutions involved in the refereeing process. The refereeing process led to the selection of approximately 300 papers that have been presented and will be presented today and over the last 2 days. Overall, we had more than 100 parallel sessions. These are the numbers of the EFMA this year. So we wish to thank all our colleagues who submitted their research, those who have presented, discussed, and chaired the parallel sessions, as well as each member of the program committee for the generous contribution in the selection process. On Wednesday, we had the doctoral seminar. This is an established integral part of the EFMA annual meeting and constitutes a unique opportunity for PhD students to enhance their results, their research skills, through keynote speeches, tutorials, and direct interaction with experienced academics. And so here I would like to thank the 2 distinguished keynote lecturers of the doctoral seminar, Professor Marafacio and Professor Luzang, for their valuable contribution. We just had the great keynote address of Professor Harford. Yesterday we had another keynote lecture by Professor Konstantinidis. So thank you very much. We are really extremely grateful to Professor Harford, Professor Konstantinidis for accepting our invitation to be here with us at the FMA and for the great contribution to the discussion. In addition to keynote lectures and speeches, we had 3 parallel sessions, special sessions. We had 100 parallel sessions that were held during the conference, featuring panel discussion on timely topics that range from digital currencies to European banking issues and finally to private equity. We are thankful to all distinguished panel participants for making the FMA annual meeting an insightful occasion of debate among academics coming from top institutions at international level. We would like to spend a few words on the 2 technological innovations that we introduced for the first time this year at the FMA, the conference mobile app and Pigeonhole, the Q&A platform that we have used. We really hope that you have enjoyed using this IT innovation. Finally, to design and organize events like the EFMA, as you know, require minds, hands, and passion of many. And this is the reason why Ettore Croci and I would like to thank several people and institutions that made the event possible. First, we are very grateful to Professor Franconelli, Director of Università Cattolica, for his constant support and for hosting the event. And we also acknowledge with thanks the substantial support of administrative offices here at Università Cattolica. They've been very helpful in assisting us in very crucial phases of the organization of the conference. We couldn't have organized the conference without the help of our sponsors, so we wish to express our gratitude to Banco BPM, KPMG, Invesco, Mediobanca, and Cassa Depositi e Prestiti. Their support was really generous, and we are really grateful for what they did for us. Finally, we thank Professor John Dukas. His 27 years of hard work took the European Financial Management Association from strength to strength. So congratulations, John, for all the hard work. I really hope you enjoyed the conference. You had a fruitful conference, and your stay in Milan was a good one. This is the hope. And thank you very much for deciding to attend the conference this year. Now I leave the floor to John Dukas so we can go on with the award ceremony.
Well, my duty tonight, thank you very much for your nice words. You have said those words several times the last few days, and there's no need to be repeated again and again. Thank you. Tonight, my role here is essentially to announce the Journal Awards, the EFM 3 Awards, and the Conference Awards, and then proceed with a formal announcement regarding the next year's meetings. But before I do so, I'd like to express our gratitude to a number of people, starting with our program chairs, Elena Beccali and Professor Ettore. Step up forward. In addition, I would like to thank the University of Cattolica. Special thanks go to the administration, the Professor Franco Anelli, director of the university, who provided us with the opportunity to have the meetings here at the facilities of the university. The FMA sponsors, the FMA award sponsors, such as Wards, Lang, and GARP. We are also thankful to members of the organizing committee, members of the program committee, session chairs, discussants, and particularly to our keynote speaker, and our distinguished speaker, and our PhD speakers as well. And it gives me also, great pleasure to thank once again Professors Mario Anoli, Gabriella Villa, Andrea Cironi, who was essentially, responsible for the JAP application, and Dr. Francesca Lenossi, all of them from the University Cattolica. Special thanks go to Mr. Mario Gatti, the General Administrator of the Milan campus, Ms. Alexandra Barros, and the student volunteers for their great services. Special thanks go to our outgoing president, Professor Annie Triandafilo, who has who organized a successful meeting last year in Athens. And Professor Ettore and Professor Beccali will taking over the presidency of the association. Now it gives me great pleasure to announce the EFM Prize Awards and the EFMA 2018 Awards. We have 3 awards: the Best Paper Award, the Reader's Choice Best Paper Award, and the Top Download Best Paper Award. The first award is selected by the associate editors of the journal, the second by the readers, and the third one based on Wiley's downloaded hits of the papers that were published in the 23rd volume. The nominated papers for the Best Paper Award, published in 2017, are the following. And also the winners of this prestigious award. Can you step up forward, please? The Reader's Choice Award goes to Annalisa Ferrando, Maria Teresa Marsica, Roberto Mura, from the Central Bank and the Manchester Business School. And the winners of the Top Download Award are David Kim, Bobek Paik, and Tanja Steiner from the University of Memphis, St. Francis Xavier University, and the Emporia State University. And now I'd like to proceed with the annual awards of 2007 meetings. And we have the conference award that has been sponsored by Wards of Wharton, Larry Lang sponsoring the corporate finance, GARP sponsors the risk management award. Here there is the typo, I see. EFMA Capital Markets Award and the PhD Award. The nominated papers for the Best Conference Award are the following 2. And please join me to congratulate the nominated authors. The winners of this award are Luigi Hale, Maximilian Moon, and David Weiss. The Corporate Finance Award, sponsored by the Larry Lang Foundation. Nominated papers are the following 4 papers. Let's congratulate the nominated authors of this award. I'll pause for a second so that you can read them all. Should I proceed? The winners of this award, of the Corporate Finance Award, are Edith Kinginger from Paris Dauphine, Camille Herbert, and Luc Lerby. The nominated papers for the GARP Award are the following 4 ones, as you can see, and I'll pause for a second so that you can go through this list. And let's congratulate the nominated authors. The winners of this award are Hao Jiang from Michigan State University, Dan Lee from the Fed Board of Governors, Ashley Wang, again from the Fed Board of Governors, and let's congratulate the winners. The nominations for the nominated papers for the Capital Markets Award are the following. 4 papers. We had more corporate papers than capital market papers, and that explains the difference in terms of the number of nominated papers. Let's applaud the nominated authors for their wonderful achievement. And the winners of this award are Francesca Anna Boldi, Barbara Casu, Elena Calotihu, Anna Sarkisian from Università degli Studi di Milano, Cass Business School, the Cyprus University of Technology, and the University of Essex. Congratulations. And finally, we have the PhD awards, and there are 4 nominated papers. And let's applaud the nominated PhD students for this award. I should say that the PhD program this year was very successful, and because of the number of submissions, we had to increase the number of groups from 3 to 4. So we admitted about 22 students out of 75 submitted papers. Excellent presentations in my own session, and also I heard the same thing from the tutors that spent the whole Wednesday with the students about their own students in their own groups. Let's applaud them. And the winner of this award is we have a tie here, Jintao Liu from INSEAD and Jialu Shen from Imperial College. Oh, you forgot the check. And now I formally announce, although it's been listed on the back page of the program, the 2019 meetings will be held at the University of Azores, the island of San Miguel. It's part of Portugal, and it's going to be chaired by our president, Professor Armada, Manuel Armada Arocha, Goltar Codo, and Pedro Pimentel. And I'd like to invite them to the podium to give us provide us with a small presentation and some wonderful pictures.
What is the... Sorry, I have to... Is it this one?
Presentation and video.
Yes. Yeah. Thank you. Well, good afternoon. Normally, we have a couple of minutes, but this place is not London or New York or Paris or Rome. It's somehow unknown for many people, so I apologize, but I'm going to use 1 minute more instead of 7 or something. First of all, we congratulate the organizers of this conference, as well as the staff. Congratulations. Then let me introduce very briefly next year's conference. In one of the 9 islands of the Azores, a Portuguese island, somehow in the middle of the Atlantic Ocean, just in front of mainland Portugal, as well as Massachusetts or Canada, somehow in the middle. So, as you will see in a very short video in a minute. Who are we? Well, I am this guy here. Some of you might remember that I was president of this EFMA in 2011, already at the University of Minho. So this is my second presidency, and as far as I know, John told me, this is an historical moment. Is the first time that the FMA has the same president twice. So I'm very glad to be a part of the history of the FMA. Why this is unusual as well? Why there are two co-chairs? Because Azores, it takes 2 hours to fly to Azores. So I am in Portugal in another university, and these are centuries ago, they were my very good students. Now I are my senior colleagues, and they have experienced organizing international conference. So that's why I did choose them to be co-chair. So I cannot fly every time to Azores. So that's why we are here. So due to the specificities of San Miguel, may I call your attention again, not only to the short video, very short video in a minute, and to the conference website as well, but now it is really important to call your attention at least for these 3 pieces of information. San Miguel, also volcanic area, 9 volcanic, don't panic. I've been there thousands of times. They are extinct for centuries, the volcano, so. So, is considered by the Lonely Planet one of the 10 wonders of this planet, in terms of islands, of course. So this is something that you should remember. Then some interesting piece of information, which is the temperature in June in the middle of the Atlantic. The air temperature is about 26, 27, maximum, minimum 20, 21. And what about the water? You might imagine in a volcanic area. 19, normally above 19, so you can swim in a pleasant temperature. Thirdly, because this is really, really important, this item. Because it is a highly touristic place, Danish, Swedish, Germans, they invade literally the area. We strongly advise you, at least those with an accepted paper or with some kind of role to play as discussant or session chair, to book immediately after receiving the information a room in a hotel. There are cities around. The island is very small. It's very, very small. It takes a couple of hours to go around the island, so a few hours. But there are some towns here with hotels. You can take taxis to arrive to the capital, Ponta Delgada. It takes 10 minutes. 10 minutes from another town. So you can book a room in some other place. Also, there are a couple of air companies for those who are afraid of flying. So there are plenty of flights to and from Azores to different parts of the world. Generally, people, they prefer to fly first to this piece of land, to this rectangle, and then fly or directly from Boston or Canada or Barcelona or Frankfurt or whatever. I was told that Delta Airlines did open a flight from last month. So Delta Airlines is flying directly to Ponta Delgado, which is the capital. So there are far more important pieces of information. I have a limited time to talk, but in the website, there will be far more information than the one I gave you. This is the most important for the time being. The video will tell you. And finally, before the video, let me call your attention for the following. Before the video, there will be a lot of surprises, but I cannot talk right now. I was told that we cannot listen the sound. But images, they will talk for themselves. So let's fingers crossed. Four minutes only. Remember, this is the middle of the Atlantic Ocean. Water straight from the volcano. The flower from Azores. Bring your camera. You can see the volcanic activity. so it's about to. The sun is going down as the movie is going to finish. Well, see you soon. Okay. Thank you.
Just a quick, thanks. Just a quick remark for the gala dinner. The gala dinner, as you know, is at Museo Diocesano in Corso Porta Ticinese 95. Now we are going to go directly to the gala dinner venue, and we are leaving immediately after this keynote speech and this award ceremony. We are going to walk together to the Museo Diocesano, so please be prepared to leave just after this session. Thank you all for your attention, and this completes and concludes this ceremony.